Okay, good afternoon. On behalf of the Hutchins Center and Brookings Institution, let me welcome everybody, including those who are watching online. I should also acknowledge and thank Glenn Hutchins, who's here today. It's been only a little more than 7 years since Lehman's failure helped to trigger an intensification of the global financial crisis, which in turn was a leading cause of the deepest recession of the post-war period. These events demanded a strong response by both the government and the private sector. The period since the crisis has indeed seen major reforms in the financial system and in financial regulation, including, in the United States, the passage of the Dodd-Frank Bill and its implementation, the ongoing enactment of new capital and loss absorption rules agreed to in Basel, a global shift to a more systemic or macroprudential focus in financial monitoring and regulation, and under the aegis of international bodies like the Financial Stability Board, as well as U.S. regulators, new attention to critical areas not traditionally overseen by bank supervisors, including funding markets, non-bank credit intermediations, and derivatives markets. So our goal in this event today is to look at some of the consequences of the ongoing reforms. Has the new regulatory regime satisfactorily addressed the causes of the crisis? What emerging risks are there, and do we have the tools to manage those risks? Are there areas in which regulation has gone too far in that the costs in terms of reduced credit availability or liquidity exceed the benefits of greater oversight? And has regulation actually made the system less safe in some ways? We're going to address these themes today in the context of some specific issues and questions. We're going to begin in a moment with a discussion of the effects of new collateral rules. We'll turn next to the issue of liquidity in the bond market. We'll hear from Governor Tarullo from the Federal Reserve on shadow banking, and we'll end with a panel discussion on these and other issues. And there will be opportunities for audience questions throughout. So without further delay, I'm going to jump to introducing the first session. The first session is about collateral rules and their effects. The presenter is Gary Gorton of Yale University. Gary is one of the world's leading financial historians and has always been a role model for me in his ability to use history to help us understand current institutions and events. He's written several books about the crisis and about banking panics in general. Gary's going to speak for precisely 18 minutes and will be followed directly by a discussion by Betsy Graseck, a managing director at Morgan Stanley Research Division. Betsy's had a distinguished career in banking analysis, including time following Japanese banks for Morgan Stanley. Her BA from Cornell, I noticed, was in Japanese studies. She currently covers large-cap regional banks in North America for the same company. So without further delay, let me ask Gary to come up.
Oh, wrong slides. We can have Daryl talk.
We thought it would be more fun.
Does this count as part of my 18 minutes? Okay, good. There you go. Okay, now the 18 minutes begins. The world is different now. It's had a fundamental change, which I describe as a shift from a system of immobile collateral to a system of mobile collateral, by which I mean that bank loans that used to stay on bank balance sheets until maturity were transformed into bonds, and these bonds could be used, asset-backed securities, for many purposes, including as collateral for repo in portfolios of asset-backed commercial paper, to post as collateral for derivatives positions, and so on. When there's not enough treasuries, in fact, the private sector produces substitutes, and this has been true for at least 150 years. So what I want to do first is show you a picture of this transformation. This is a figure that shows you the components of privately produced safe debt as a percent of total safe debt. Okay, the components of privately produced safe debt as a percentage of total safe debt. This is flow of funds data. So you can see that in 1952 or so, that by far the dominant part of privately produced safe debt was demand deposits. And what you can see is that it just drops straight down. And instead, what's rising are these two. instruments, including money market funds, repo, asset-backed commercial paper, private label securitization. This went to back this. This is composed of all the loans that you back this. Let me just say a couple things about this. One thing you need to understand is that this didn't start in 2000, right? It didn't start in 2002. It started around at the end of the 70s, right? And it's a fundamental shift. Now, and in fact, it turns out that this was the part that everyone knew about and which was regulated. Shadow banking. To the mic. Oh, okay, sorry. So if you had seen this, say in 2000, you might have observed that there was this transformation, which emphasizes that without the right concepts and theories, you don't know what to measure. There's nothing special about these data. This is Fed flow of funds data. Now, the problem is that, as we saw, this new system had the same problems as the old system. It was vulnerable to bank runs. And as a result, there's all sorts of reform, which for the most part is aimed at going back to a system of immobile collateral. That's just very comforting to go back to the 60s when we could feel good. And that's because many of the new reforms require that collateral be posted and be stuck there. And in particular, the one change that is extremely important, the most important change, is the BIS's liquidity coverage ratio. The liquidity coverage ratio says, in effect, every dollar of repo has to be backed by a dollar of treasuries. So just to understand what that means, that says that one kind of money, treasuries, has to be pasted together with another kind of money, repo. Private money, repo, has to be backed by government money, treasuries. So treasuries do have a convenience yield. This is a picture from Krishnamurthy and Vissing Jorgensen, and you can see that as the ratio of treasury debt to GDP goes down, the AAA corporate to treasury spread skyrockets. So we've known for quite a while that treasuries have a convenience yield. In fact, the last two treasury bill auctions went off at a zero yield, so you're basically buying like a $10 million $10 bill. So I want to stop and ask ourselves, how should we think about this? Right, this is this major change, the liquidity coverage ratio, and how are we supposed to assess this, and how are we to think about this? So Bob Lucas, many years ago, put forth this notion called the Lucas critique, which had to do with unintended consequences. So it's something like this. Recently, the airlines adopted a policy that you have to pay $125 each direction if you take your dog on the airplane. Right? You'd have this little dog, you put it under the seat in front of you, it used to be free, now it costs $125 each direction. And what happened was there was an exception to this rule that if your dog was an emotional support dog, then you could take it for free. So you can go on the internet and Google emotional support dog, and you find this doctor in New Jersey who will sell you a note. And you use that note, and then your dog goes for free. And airlines are worried that they're going to have more dogs than they used to have on airplanes. Right? So this is an unintended consequence of a policy that, no, it's not that important of a policy. But the question is, how do we think about the liquidity coverage ratio? Now, the BIS, they tried to forecast how much extra collateral was going to be needed, and there were many forecasts, and they ranged from 800 billion to about 4 or 5 trillion. And there was no serious, I would say, serious attempts to understand the unintended consequences. So I want to look at that today, and I'm going to look at that with a system that was exactly the liquidity coverage ratio. Exactly. It said that national bank notes, this one is from the National Bank of Fort Myers, Florida, had to be backed by treasuries. So the National Banking Act came into existence in 1863 to finance the Civil War. to create a demand for treasuries, but it had a byproduct which was much noted at the time, which was that it would create a national currency that would trade at a uniform price and would not be subject to banking panics, national banknotes. And the reason people had this view was because it was going to be backed by treasuries. So the problem was noted in 1913 by an economist who pointed out that there was this huge underissuance problem. It seemed as if there was an arbitrage opportunity. Banks could buy treasuries, take the treasuries to the U.S. Treasury, get their notes, and then lend out the notes. The return on the treasuries they deposited would accrue to the banks, just like in repo. You deposit to treasuries, but you get the return and you get the money you can lend out. And there were a number in the subsequent 100 years, economists calculated these so-called arbitrage profits, and in some cases they claimed they were infinite. And in fact, what happened was, if you take into account two things, that treasuries have a convenience yield and that you shouldn't be calculating the average profit but the marginal profit, it turns out there's not really a puzzle. Banks did not want to use all their treasuries to back national banknotes. And so there was a shortage of national banknotes. Now, one way to interpret that is that treasuries had another use because of the convenience yield, and the ratio of 1-to-1 was just out of thin air. It's like the BIS. The 1-to-1 ratio is not, has no empirical support at all. So what happened during the national banking era? Well, as treasuries to GDP dropped, which is the black line, the ratio of banknotes to demand deposits rose, also dropped. Notes to demand deposits dropped, so demand deposits grew. Okay? So you can see that the correlation is 0.96. Okay? So what's happening is, as treasuries became scarce, and banks did not want to use all of them to back national banknotes, a shadow banking system arose. A shadow banking system arose. Demand deposits. And at the time, that's the puzzle in the late 19th century. Economists were writing articles with titles like, "Are Checks Money?" And there were surveys done by the Comptroller of the Currency, by the National Monetary Commission, in an attempt to find out the extent of use of checks in transactions. Okay? So the result of this liquidity coverage ratio during the national banking era was exactly, there was this rise of the shadow banking system. So, it's a little hard thinking now, looking back, thinking how could these people not have understood that checks were money? Well, they really didn't. Bray Hammond, who wrote the last Pulitzer Prize winning book in banking, the importance of deposits was not realized by most economists till after 1900. Well, not quite. Here's Russell Leffingwell, Assistant Secretary of Treasury. All of these people who believe in the quantity theory of money choose to call bank deposits money, but bank deposits are not money. So there was this fundamental confusion about what demand deposits actually were and why they had grown to such an extent. Meanwhile, there's 5 major banking panics during this period. And these banking panics are situations where people want to get the cash, the national banknotes, in exchange for their checking accounts, right? So it's not as if you couldn't observe that there was a problem with checks. We saw this repeatedly. The problem is that people didn't know what to do about it. And partly it was this conceptual confusion. The bankers, by the late 1880s, lobbied heavily to have what they called an asset-backed system, by which they meant the national banknotes would be backed by portfolios of loans, not by treasuries. But we had seen that system in the free banking era, and that also had banking panics. So this I want to emphasize, is an exact parallel. And I used to hear this much more often than I do now, but one response is things are different now. Things are different now. And I spent 25 years researching banking crises, and if I had a nickel for every time I heard things are different now, I'd be retired, living in a mansion somewhere. So, I think there's two points. One is, when you have such a significant change as the liquidity coverage ratio, I don't think you're allowed to just shrug off the Lucas critique. I just don't think that's acceptable behavior. And I think that it's not only with liquidity coverage ratio, but there's other examples in history that are quite close to other policy issues. This one happens to be exact. So the liquidity coverage ratio and the national banking system are exactly the same. When you paste two kinds of money together, public money and private money, it's going to cause a shadow banking system to arise. Okay? So let me add that, you know, the horizon to think about here, your horizon should have gotten longer because of the crisis. I mean, I've noticed that bank regulators in particular, you know, their horizon is about a year, maybe. And this is something, this rise of demand deposits happened over 50 years. And the first figure I showed you about the development of the shadow banking system happened over roughly 40 years. So the horizon here is a lot longer than you normally think about. And so over some period of time, we can expect the banking system, the global financial system, to morph somehow. And a lot of people are spending a lot of time thinking about how to do that. And that is going to be something that happens slowly relative to how most people think about things changing. So this was a system that basically failed, the national banking system. And eventually we got deposit insurance over the objections of economists. So I think we're going to have the same problems. We're going to have unintended consequences of another shadow banking system. And I think that like the national banking era, despite what people think, I think they're a little bit overconfident in understanding the conceptual issues about repo and short-term bank debt in general. So I think there's a very strong lesson from history here. And I would say, you know, I guess those who ignore history are entitled to repeat it.
Okay, thank you. Thank you very much, Gary, and thanks everybody for inviting me to be here to discuss my views on not only Gary's comments, but just generally as it relates to the topic that we have today on whether or not the system is safer. Just to level set, I am a U.S. large cap bank analyst at Morgan Stanley covering large cap banks in the equity research department. I've been doing that since '02, so as a result, I have been doing it during the crisis and post-crisis period, and I did just want to say, because I haven't had the opportunity to do so in person, thank you very much to Dr. Bernanke, because from where I sat trying to estimate the value of banks and their earnings during that period, I greatly appreciate all the work and effort that you had to endure. I would also like to highlight that that what I'm going to be speaking about today are my views. They're my own. They're not attributable to Morgan Stanley. And my answer to the question is yes, I do think that the regulations that we have in place since the crisis have made the system safer. That said, I do have a couple of comments that I would like to talk about in relation to Professor Gorton's piece. Two parts: one, what I agree with, and second, what I would like to add to it. First, on what I agree with, three key pieces. One, the liquidity coverage ratio, in my opinion, does reduce the velocity of bank balance sheets. Two, Treasury yields, I do think, reflect a convenience yield. And three, all other things equal, at the margin, the liquidity coverage ratio should incent banks to take some riskier assets. This isn't all bad. It's just, you know, I do think that that's, I'm in agreement with Professor Gorton on that. Just to elaborate a little bit, why does the LCR reduce the velocity of bank balance sheets? This is basically because what the LCR requires banks to do is hold high quality, lower yielding assets today to offset the risk of deposit outflows, credit line drawdowns, or derivative counterparty deterioration, things like that in a stress scenario. So what you're being asked to do as a bank is increase your holdings of treasuries, really treasuries, RMBS too, but really treasuries today to offset the potential of a stress environment in the future. And it's happened, right? Because banks are holding 8 times more treasuries than they did pre-crisis. Second, I do think treasuries reflect a convenience yield. In the LCR ratio, treasuries are at least 20% more valuable to a bank than the next best thing, RMBS. Of course, reserves at the Fed are also as equal. And in fact, you could argue maybe even a little more valuable than treasuries. But relative to RMBS, another kind of securities, treasuries are at least 20% more valuable. And so this is a good, a good that a bank wants. And as a result, you do have a special status for treasuries. All other things equal, the curve would be flatter than it is, than it would be otherwise, I should say. And then third, at the margin, the liquidity coverage ratio should drive banks to put on riskier investments, all other things equal. So I want to make sure I'm very consistent with that, all other things equal. If you have a bank today that's earning its cost of capital, which I would argue is about 10 to 11%, I know there's been some discussion out there that it's less. I totally disagree with that, and a lot of investors I speak with do as well. 10 to 11% is the cost of equity for a G-SIFI bank. You can look it up, it's on Bloomberg. So that if you are driving, if you are generating a 10 or 11% equity, return on equity right now today, you're just delivering the cost of equity that shareholders want. So what does that mean? That means that if now you have a new rule, which is the LCR ratio, suddenly you have to allocate a little bit more towards treasuries. They're lower yielding than what you're making in return on other assets that you have, like loans, for example. And so as a result, if you want to keep that return on equity equal to what your cost of equity is, then you're going to have to barbell it, right? You're going to have to go out a little bit more on the duration risk or a little bit more on the credit risk to get that same ROE that your shareholders are looking for. And remember, banks and bank managements do have shareholders that they must address and must report to. That's a legal requirement, board of directors thing. So, for an example. So banks will have to invest in riskier assets. Now, look, you could come back to me and say, well, wait, what if a bank is earning 15% today and they're only having to earn 10 to 11? So can't they reduce their return on equity and get safer at the same time? Short answer is yes. So that's why I want to be clear of saying all other things equal. That's what it would imply. I wanted to add a couple of things to Professor Gorton's note as well. In our opinion, and this comes from speaking with some other folks in our organization, and we did put out a paper on liquidity back in the beginning of this year with many of my colleagues cross-border as well as in other departments within Morgan Stanley. So I kind of draw on that for some of my comments I want to make. There's a couple of other things I want to highlight in addition to what Professor Gorton said from some of the rules and regulations and some of the upcoming rules and regulations that we don't have out yet. We do see 4 additional sources of demand for treasuries, so it's not just LCR, which is making treasuries a greater good or a more valuable good for banks. Number 1, implementation of interbank derivatives clearing. Number 2, TLAC, which is the total loss absorbing capital rules, also known as the too big to fail rule. 3, money market fund reform, and 4, higher rates. Why do all these things drive more demand for treasuries? Well, let me take through it briefly. 1, implementation of interbank derivatives clearing. Starting in September of 16, which is a little less than a year from now, dealers will be required to clear derivatives that they trade with other dealers. That will require them, the dealers, to post high-quality collateral at the clearinghouse, and treasuries are chief among them. Several tens of billions of dollars of incremental demand for treasuries coming. Second, TLAC rules. Total loss absorbing capital rules require banks to issue incremental senior debt, at the holdco level. And, the idea here is to have enough debt waiting in the wings in the event that there was a resolution event, or that's probably the wrong word I'm using, but an event where you needed to bail in incremental equity. So you have to have more debt in order to have enough potential equity. That's what I kind of call it. So all other things equal, that will also drive an increase in treasuries. Because if you think about a management team today, you're balancing your risk-weighted assets. How risky are your assets? You've got some lower risk assets, some higher risk assets. And if you have to issue debt, now you have to keep that balance aligned between the risky assets, the less risky assets. So as a result, you'll see another tens of billions of dollars of demand for treasuries. And you might be sitting here saying, who cares about tens of billions of dollars? Is that really, a marginal buyer of size for me to worry about? Treasury demand. Well, let's get to number 3, which is money market fund reform. Money market fund reform is kicking off, well, it's already kicked off, but it's going into effect October 2016, so a little less than a year from now. And one of the key things with money market fund reform is you have to decide as an investor in MMFs today, do I want a stable NAV or do I want a floating? And if I want a stable, I have to invest in government bonds. And right now today, there's 2.7 trillion of money market funds. 1.2 is currently in governments. 1.4 is what we call prime, so non-government. And we expect that some of that's going to be flowing into government. So we expect that retail, which is, $500 billion of prime money market funds, that not all of those people actually want floating NAV. They might want stable. So you'll see some incremental demand for treasuries there. Maybe that's a little bit more incremental than the first two. And then you have higher rates, which comes with some risk if there's any impact of higher risk on your flow of deposits. Because with the LCR, one of the things you have to do as a bank is say to yourself, well, what's the potential risk for an outflow of operating, non-operating deposits? And not to get too technical here, but if you assume wrong, you might have to buy some more treasuries to make up for that. And I think one of the things that all of this that I just went through indicated is there are other rules besides the LCR that are going to force an increase in demand for treasuries. There's also rules with multiple competing interests, I should say. And you can see that with the money market fund reform as well as the LCR. There's some competing interests there. You can see it in the common equity tier 1 ratio versus the SLR ratio versus the LCR ratio. And we have a few new rules coming as well, like the fundamental review of the trading book as well. Potentially, I hear it's coming. I don't know exactly, but supposedly it's coming. And the minimum requirement for the CCAR ratio for GSIBs, is that going to move up or not? So these are all very important rules that I do think has made the system safer. We do have to understand that there's some competing tendencies there, competing goals, I should say, within these rules, and it can force some unusual outcomes. For example, in the case where JPM recently decided to reduce its non-operating deposits to try to reduce its SIFI buffer and help out its SLR. And I say unusual, and maybe it was an intended consequence, I don't know, obviously, but maybe I say it is unusual because bank managements don't come to work every day looking to shrink, right? They come to work every day looking to grow, to drive profit for their shareholders, to do well with their clients, to give back to their communities. And so it's unusual to want to shrink, but that was a consequence of the rules that have been put in so far. And what I wanted to just end on was a comment around where those deposits went. So some of those non-operating deposits, yes, went to smaller banks. They don't always have the right products to serve. Some of them went to money market funds. Some of them went to treasuries. Professor Gorton's comments about how you had a zero yield in treasuries recently at a recent auction, I think, was in part because you've got banks saying, we really need to be careful about how much in deposits we take onto our balance sheet. So, rules kind of driving a push of economic and financial activity towards shadow, could be an intended consequence, but it is something that is happening right now here today. So thank you for your time.
Okay, thank you. Thanks both. Let me just start and ask Gary, did you have anything you wanted to say in response to the...
No, I pretty much agree with all that.
Okay.
Other sources of demand for treasuries.
All right, so I'm going to ask a couple of questions, and then I'm going to open it up. Let me start with you, Gary. So I know you for a long time, so I know what you're getting at here. The whole point of your talk essentially is agnosticism, right? You're saying that when you make a regime change, other things are going to happen, and they're really hard to understand what they might be. But I was trying to, I think it might be worth speculating a little bit on the kinds of things that might happen that we should be looking out for. So, for example, in analogy to your deposit, your historical example, you could imagine if checking accounts backed by, or bank repo backed by treasuries are not economically efficient, that you might have, for example, more repo moving into shadow banking backed by credit securitizations, for example, or alternatively some substitute for repo with a similar structure. Is that the kind of thing that you're thinking about, or is there another example?
No, that's the kind of thing. It's some form of short-term debt that's going to be backed by some form of privately produced collateral. But I would also emphasize that in both the national banking period and the development of the shadow banking period, this happens over a long period of time. Mm-hmm. And because it happens over a long period of time, I think we tend to get sort of lulled to sleep. We don't actually know where to look. I think we know where to look now. The question is, are we going to know where to look in 20 years? And the other thing is, I do think this conceptual confusion is very important. The national banking era, it was very smart people, and they were confused about checks. And I think the confusion about repo, for example, contributes to this idea that we don't have to worry about the development of another shadow banking system.
So I guess to follow up, is this a counsel of despair? Because you said earlier that deposit insurance was implemented, yeah, which is clearly a regime change. Yeah. You sounded a little bit more favorable about that particular change. Given that we were very unhappy with the way the system was working in 2007, and we had to do something, how would we think about the right regime change?
Well, I don't want to be too much of a pessimist, but I would point out that both the national banking era and deposit insurance were almost accidents of history. These were not by intelligent design. Economists opposed deposit insurance, and national banking was to finance the Civil War. So I think it's an intellectual problem and an educational problem to get to the point where we can, as a society, implement changes I think would be for the better. But the problem is banking crises don't happen often enough for us to really get momentum on that. So it's for example, I thought one of the most important things that we should have gotten out of the crisis was a new system of measurement. Not replacing things, but adding to it. And I wrote this paper with Brunermeyer and Krishnamurthy, and at the time I said to these guys, this is going to be the most important paper we ever write. And we tried really hard to make...
Important or impotent?
Well, important. But, and I thought, we would be able to get that because during the Great Depression, is when we got national income accounting started, right? So I was sort of hoping for that, but we didn't even get that. So I think there is a sense of overconfidence about the reforms that we have adopted. And I think the fact that things change so gradually is very dangerous for us. I'm not optimistic.
Humility is always a good
idea.
Yeah. Betsy, if I could ask you, you were talking about how the LCR would push banks into riskier investments. So in principle, assuming the binding constraint on the capital requirement is the risk-weighted assets and stress tests as opposed to the leverage ratio, assuming that's the case, in principle, obviously the risk weights might not be right and so on, but in principle, wouldn't that solve the problem because you need more capital for the riskier investments?
So yes, that's accurate, but you also are trying to triangulate to a certain ROE outcome. And as a result, if your RWA is your binding constraint, you have a little bit less wiggle room than if it's your SLR is your binding constraint. So to your point, it depends on which one is your binding constraint. And institutions kind of migrate between them. And at the same time, and that's, I guess, part of the challenge with all the different rules, at the same time, they're trying to triangulate as a goal to at least earn their cost of equity.
Okay, let me open it up. Steve Cicchetti. We have
the mic's next to me.
Mics.
Yeah,
okay.
Fine, thanks very much. I guess I'm here to provide the Basel response. I'm Steve Cicchetti from Brandeis International Business School. So first of all, I think that that when we were designing the LCR, we thought about it more as a reserve requirement an analog than as a backing for demand deposits the way you said. So it's important to keep in mind that the rate of backing is is far below 1. So it's for standard retail deposits, it's 3%. So that really does reduce the amount that you need. I think it's also important to keep in mind that we wanted to try and make sure that central banks were the lenders of last resort for commercial banks, not the lenders of first resort for those banks. So a lot of what we've seen, I think, is in fact has been intended. And the reductions in ROE of banks that has come from this, that's what we were hoping for. And of course, I can't remember being more upset than the day that that one of the largest bankers, the CEO of one of the largest banks in the world, stood up in 2010 and said, I'm going to get an ROE of 13% for my banks. I said, well, this is ridiculous. I mean, the whole point here is to drive ROEs down into the realm where you have safer institutions. I'll also say that I think that there are plenty of treasuries out there. Reserves count for high-quality liquid assets. Treasuries count for high-quality liquid assets. And in jurisdictions where there aren't enough of either one of those, then central bank credit lines count for high-quality liquid assets. Finally, I'll just say that treasuries as a fraction of total assets in the banking system in the U.S. today is below where it was in about 2005. So it did go down, but it's way lower than it has been in the past. So I agree that we have to worry about unintended consequences, but it seems to me that the idea of liquidity regulation is something that we need, and we just have to figure out how to do it properly.
So this paper was written for the BIS annual conference, so I've heard from many BIS officials and so on, and they all say the same thing, like you. And I think you're kind of missing a few points. One is that, the Lucas critique is a serious thing. So I have an exact parallel. It didn't work out well. So quibbling over the numbers is not the point, right? I think you have to do better than that. I mean, I was told by the head of the BIS, he said, well, we had to do something.
I'll just make one quick comment.
Sure.
13%, I don't know if you're referring to JPM with their ROTCE goal, but their ROE is only 10. So a lot of bank managements speak to the ROTCE, the return on tangible equity, but in fact, the shareholders are buying the total equity. And
what if it's 7?
much
So
lower.
what?
It's too low.
Too low for what?
Too low for shareholders because, look, if I am a bank investor and I am going to recommend a bank stock to my CIO, I'm not just competing with banks historically over time. I'm competing right now today with what other investment opportunities are out there in the marketplace. And it's 10 to 11%. It's
But
not
Steve,
6 to 8.
you don't get to decide, what banks earn. You get to decide where banking is. Is it in shadow banking or is it in commercial banking? That's the decision you make, right? All these regulations, that's what you determine. You just determine where the banking system is.
What's the ROE, do you know, on utilities?
ROE is a little bit lower, but importantly, their yield is much higher. And one comment I would like to highlight is that there's 3 basic kinds of bank investor or stock investors. There's value, there's growth, and there's yield. So you don't really want banks to be value stocks, do you? I mean, because that's essentially what they were in 08.
I was asking the question about being utilities and having a lower ROE.
Well, but
Yeah.
they also come with a very high yield.
Mm-hmm.
So when we are not able to invest in bank stocks because the crisis is over, there's not as much value out there, and the yield is not there. Utilities have 4, 5, 6% yields. A yield investor wants an S&P plus 100 basis points at least, and we're only yielding 2, 2.5. Then you're basically forcing management teams to listen to growth investors. And I'm not sure that that's necessarily what you're looking for as a regulator. I would think what you're looking for as a regulator is to have a shareholder base that is going to support the safety and soundness objectives of all the rules and regs, which really is your yield investor who's looking for stable, solid, slow book value growth, consistent dividend as well. So that's where 30% payout ratio is a little low for that.
Any other questions up here?
Sergey Kostev, Financial University, Moscow, Russia. I have a question. Can you provide some comparative perspective on the issue? How are things in Britain or Europe in general? Thanks.
I didn't understand the question.
How
So-
are things, is what Gary talked about true also among the European?
Ah,
Well, they're subject to the LCR also. So to that extent, yes.
could I just, real quick, you mentioned bank reserves. Does the BIS have a view on how big the Fed's balance sheet or a central bank balance sheet should be? No.
No.
But in principle, right, that's relevant to the supply of safe assets.
So when I... Okay, so, I mean, I will tell you that in the discussions of the LCR, there was a lot of discussion about, which I think you were involved in some of, about the technical aspects of the interactions between operational monetary policy and the liquidity coverage ratio. And there the discussion was that there may have to be more reserves in the system. And that since those were interest bearing, you know, that would be fine. I mean, my own view, as I said, is that I think of these as like a reserve requirement. So in the same way that a reserve requirement can drive deposits out of the banking system because of the costs, and there, I mean, I agree with you, Gary, on that point. That it was possible that high quality liquid asset shortages could restrict the size of the commercial banking system, and that you had to be careful about that, and that you didn't want that to happen. And so my proposal at that point was that what we should do was adopt the Australian process, which is to have basically an elastic supply of high-quality liquid assets provided as an off-balance sheet item for central banks, and the price of those would create actually another policy instrument. But that's a sort of slightly different discussion.
No, but it is related. I think you're right. I mean, the thing is that, you know, in the period when we had deposit insurance protecting most of the privately produced debt, we didn't have, the central bank didn't have to worry about the quality of the bank collateral, right? It was a bank examination issue and so on. In this new system, the quality of the collateral out there matters a lot. And so open market operations, which trade one kind of money, treasuries, for another kind of money, cash, has an impact on, you know, the extent to which there's treasuries out there. So now, you know, and I think implicitly, and Ben can correct me on this, but I think the reverse repo program is eventually going to have to be the way the central bank can worry about whether there's enough high-quality collateral out there by changing that rate. Now, the question is that going to interrupt with, you know, sort of, you know, normal monetary policy? And I think there is no more normal monetary policy, right? There's just no going back.
Questions? Anyone else? Over here.
Hi, thanks. Rodrigo Valderrama, Plantation International. With regard to the high use of Treasury notes to back up collateral for loans, don't you get into a chicken and egg situation where you really turn the banks into a public institution when they keep getting backed up by public money rather than just private money?
Well, the private money is the short-term debt that banks are going to issue, which has to be backed by treasuries, right? So if banks don't want to use all their treasuries for that purpose, then we're going to see short-term debt appear somewhere else. You know, that's sort of the issue. And again, I would say it's an issue over, say, 40 years, not, you know, next year. But I would just add one other thing about this demand for safe assets, because we both mentioned the Treasury auction. I mean, I think one reason there's no inflation is because everybody wants to buy safe assets. You have no money multiplier. We're stuck in this world where, you know, everybody wants treasuries. They bid on treasuries. This is Caballero and Fardy's point, not mine.
Over here.
Ted Murphy from CRS. Just a quick piece of bank history trivia that might play into whether or not things are in banking or shadow banking. I believe that the Bank of England had a monopoly on banking issued by Parliament, and then in the rise of deposit-funded banks in the 1800s, that was the Bank of England tried to enforce its monopoly, and Parliament said, no, you're a bank, they're deposit-taking institutions. So where I'm going with that is to accept your premise that we change the rules on what we're calling the regulations, and then if we start thinking who else and how else could someone who's not what we're calling a bank today fund the same kinds of activities that you're bringing up that we need to think about in the shadow banking system. So someone in 1835 in England could have imagined someone can fund the kinds of things the Bank of England does by accepting deposits and then think, oh, we need to do things with deposit regulation. You're bringing up a good point. What kinds of things can we anticipate? Who could arrange a set of contracts similar to what you're bringing up?
I think it's very difficult to anticipate it. I mean, I think it's, it's a matter of horizon. And again, we didn't do anything about measurement. So right now, I think everybody's kind of overconfident, but that's because they have short horizon. I'm not, I think, I mean, who knows? You could issue dollar-denominated bearer instruments in China. Who knows? I don't know.
Bobby Pestrong, Just a Citizen. Addressed to each of the speakers, what should the layperson in the United States who is concerned about the effects of the last recession and the issues that you've been discussing today, what should he or she be thinking about relative to what government and the private sector should be doing to prevent another disaster like the one we've just been through?
Well, I don't want to be too pessimistic again, but let me tell you some American history. By the way, you don't have to say just a citizen. A citizen is good enough. No, financial crises are the norm in the United States and in other market economies. It's not, the period that was very unusual in the United States was from 1934 to 2007. That was the unusual period, right? It's harder to explain that than it is to explain crises. So in all these crises, the same thing happened. You have a big crisis, you get this massive blowback against bankers, some legislation is passed, and 7 to 10 years later is another big crisis. And it takes a while, I think because of the infrequency, for ideas to kind of seep into, consciousness. I mean, deposit insurance, we had tried in some states before the US Civil War. Some states tried it in the early 1900s. But those were on the state level, and it became a sort of populist mandate before deposit insurance was passed. So I think ideas for reform just take a while before they sink in. I mean, I propose some things about reform, but I mean that's what we observe. I somehow just don't see this time as being any different. We pass some stuff, maybe some of it's good, it doesn't address the fundamental problem. We're kind of confused, off we go, and there'll be another crisis. I mean, I mean, if you think, I think the other point of view is the one Steve was pushing, which is, this time is different, and, we don't pay attention to history, right?
I think the summary is if you modify a complicated system, you have to be careful of unintended consequences.
Yeah.
Any last words?
I think we've done a great job.
Excellent.